Hey everybody, Kevin Shortell here again with another episode for you of Real Estate Without Renters. And thank you as always for sharing the show, subscribing to the show. And if you like the show, please go ahead and give me a nice 5-star rating there. That does helps me attract more guests and actually motivates me to do more and more of these podcasts for you all. So I do appreciate that, especially those of you also real estate investment clubs, real estate note investing clubs, any investment clubs, meetup groups, anything like that to share the show. I do appreciate that as well. And by the way, as always, if you have guests that you would like to have on the show that you think would be a good fit, just let me know and I would be more than happy to invite those guests on. But I always want to keep these informative. I always want to keep these on topics that are important to us, things that are money-making opportunities. But of course, a part of that is the risk side of the business as well. So speaking of risk, that is going to be our topic here, but not the normal type of risk that we talk about. Oftentimes on this podcast, I talk about risk associated when you're initially getting into an investment. Now that's important, of course, when we look at things like investment to value ratios that I've talked about and everything else. We look at the collateral value behind what we're investing, and certainly that's a part of risk. We're going to switch a little bit here and talk about what happens after and while you own that particular asset. How do you cover yourself in risk? So it's going to be a great topic, a very important topic. And I'm telling you, I'm excited about this interview because this is something that has been just really lightly talked about, if at all, in the industry. And I'm telling you right now, all of you who own contract for deeds and land contracts, you will need to take notes about this, and you're going to have to start to take action on your portfolio pretty much immediately after you hear what we have to talk about. So this is a big topic in a big industry. Before I jump right in and introduce my guests, let me thank my sponsors over at Noteworthy. NoteworthyUSA.com is the website. You can get to NoteworthyUSA.com and you can see all the information about our live events. We just had a great event in California, in Anaheim, and a really good group of people, great instructors, and it was really a top-level event. And the next one, I believe, is going to be here in Orlando, but it will be more than likely somewhere here on the East Coast coming up in October and November. So you can check that out at Noteworthy USA. And don't forget, there's also a great publication. It comes out every single month. I contribute 2 articles to the Noteworthy newsletter every single month, and a really good industry publication. You can subscribe to that. I believe for my listeners, they're giving you a free one edition of that, so you can get a feel for what that is all about. And we have really good content within that, things from anything from underwriting. It also gets into real estate investing as well as notes. So if you're in this industry, you want to learn more, see who the players are, certainly subscribe to that newsletter as well. All right, so on to the rest of the show here. I was mentioning this is about risk. And one of the things we have to do in our industry is identify all the risks, some of which we can do, some of which we can calculate our own risk. But in our world, there's a lot of unknown as well. And when we have unknown risk of what can happen to things in life in general, acts of God, if you will, all these sorts of things, we have to cover that risk. We can't always prepare for it without it. We cover our risk by getting insurance. And it's an extremely important topics. And I brought in the best in the industry from Lloyd and Associates. I've got today Beth Boisseau-Coots with us. And I'm just thrilled to have you on. We had a conversation, I guess last week, and you really just blew me away with some of the things that you were talking about, where there's so many misunderstandings within our industry about the proper coverage on things. So for me to kind of set the stage for my listeners, if you have a note in a mortgage, there's one type of insurance that you're going to get covered. But if you have a land contract, also known as a contract for deed, there's different types of coverage that we need to look at. And I'm sure most of my listeners are going to be familiar with forced place insurance, but do you really know what it is, what it really covers? Are you fully covered on everything? So we're going to hit all of those topics here with you on the podcast. So Beth, welcome to the show.
Thank you. Thank you for having me on.
Absolutely. I'm really looking forward to this. So why don't we start simple? Most people who get involved in the note business invest in your basic note in a mortgage or a deed of trust in a mortgage, which means they're not on the deed to the property. So what kind of risk do we have from an insurance point of view? What kind of risk do we have as a note, just a simple note and mortgage owner?
So a note, a note owner or someone who's not on the deed but has an interest in that distressed mortgage, they're the same as any other lender. So they have an insurable interest, but they are not the owner. They're not on the deed. So their primary risk is going to be what the loan amount is or what their investment is. And so the appropriate insurance coverage for that is going to be a forced place policy where they are able to cover their interest in the property, which is typically the loan balance. And so they're protected. Now, this doesn't cover them on the general liability side because they have no exposure there, just their interest in that.
So by general liability, you mean if somebody slips and falls at the property, someone gets hurt on the property, that's a general liability. And because the note investor is not on the deed, they're acting more as the bank. They don't have any liability for somebody getting hurt on the property.
That is correct. Yes, they are exactly like the bank. They have no exposure to if there's a bodily injury claim or property damage. And what I mean by property damage is if like the tree in the front yard of that property that they have the note on falls and hits the neighbor's car, that would trigger a general liability policy.
Gotcha.
So because they're not on the deed, they have no exposure in that sense.
So the exposure, if something happens to the property, it's damages our collateral is one way to put it. So the property for us is the collateral, right? So if something happens to that collateral where it's destroyed, we want to be, protected by that. So that's the, and what's the proper terminology there? Just the financial liability for the property. I'm probably using the wrong term there.
Yes, no, that is correct. So yes, their interest in that property from a financial perspective. So, typically with a lender, a traditional lender, it's going to be the loan balance. With a note investor, even though from an insurance perspective, we look at them as the lender, it is a little different. And typically the note investors want to cover what they bought. I know that there's a term you guys use, but
yeah, how much we invested versus what the
right.
unpaid balance is.
Yes, UPB. Yeah. Thank you.
Yeah.
I got it. I do hear that quite a bit.
Exactly. Yeah, because we typically buy a discount of the UPB. So we would like to be covered for the UPB, which would include our, a gain in there, if you will, on the payoff. Yeah.
Exactly. Yes. So that's what the forced place does. It's going to protect the financial interest of the lender, whether it's a bank or a note investor.
So if we're buying forced place insurance, can we get 80% of the value of the property? Is it only UPB? Or could we make it UPB? Could we request it's only for what we invested in the property? Or could we even, maybe we decide to self-insure if it's a small balance and just say, I don't need to cover for my whole investment, but maybe this amount. So is there varying amounts that we can do within reason there? I know it'll affect the premium, but.
Yes, and it does affect the premium, but on a forced place policy, a lender can force place insurance up to the replacement cost of the property. Now, there's a caveat with that. You can only charge the borrower for the unpaid balance. But as the lender, you can force all the way up to the replacement cost. And typically that becomes more of an issue when the property is going into foreclosure.
Okay. Now, today, forced place insurance for the most part, unlike years ago when I got started, we used to buy individual policies. And then it became more of an umbrella policy that my company, let's say, could buy. And then every note, I could, just add under that umbrella. And then it evolved to most of the servicing companies now providing that type of coverage underwritten by companies like Lloyd's. Is that correct?
Yes, that is correct. And some of the companies will still offer single one-off, one property forced place policies. It's rare. The majority of them are what we call master policies, where once the policy is in place, then the lender or the servicing company can add properties to the policy as necessary, and then also remove them, and they pay for what they use. With that, sometimes the servicers or the banks will put in place tracking. So they're also outsourcing the tracking of the insurance for the borrowers. And then the tracking company, which we have that as well, will then place the coverage as necessary for the borrowers. And the tracking company will handle the, the letters to the borrowers and whatnot.
Mhm.
So there's a variety of things, but yes, you as a lender or a note investor can put in place what is called a master policy and then manage that yourself via an online system. And the thing about that as well is that if the property then goes into foreclosure, if you are having to foreclose on that borrower, you can go in online, change the status to vacant. It then becomes a foreclosed property, and then general liability is added to that as well.
Oh, okay. Okay. And that's if you have individual policies for your
Oh,
company.
no, I'm sorry. That is a master policy as
Master
well.
policy.
That would be the same thing that the tracking companies use. Now, on an individual policy, if you have that type of forced place coverage on your note, then if you have to foreclose on the property, you would need to let your agent or the carrier know, and then they would
have to switch it. Yeah.
Yes.
Okay.
Exactly.
Okay. Now on the forced place that comes, well, let's clarify too then. So forced place, we put in there when necessary, right? So if our borrower who's on the deed to the property, we just have the lien in the form of the note, the mortgage, if they have their own policy that covers liability as well as hazard or financial risk on there, we just need to verify that we're on there and register as a mortgagee beneficiary.
Well, yes, you'd need the borrower to provide you, a declarations page showing that there is insurance coverage on that property. And then also it would show that you are added as the mortgagee on that policy.
Okay.
If they fail to provide that, or if you are not added, then you can force place the coverage.
Right. And I guess the rule of thumb, of course, would be to cover ourselves if we don't know. If we're in the process of buying a note and we don't know because we haven't seen a declaration page, which is proof that they have insurance that the property is covered, we should get forced place insurance until we establish the fact that they do have their own insurance in place. And then we can cancel the forced place insurance and then just re-verify every new renewal period that they have the policy in place.
That is correct. Now, with that, if they come back, let's say you forced the insurance because they were slow getting it to you or you just didn't know, and they come in and they show you that they had it the whole time, then you must refund any premium that was added to that note to them. Or if they show that they got it during that period, then you would prorate it and refund, from the day that their policy went into effect.
Okay. Yeah, that's fair enough. And they're in general terms, it's less expensive for them. It's less expensive for them to get their own insurance. So obviously,
so much less.
We want to try to motivate our borrowers. Please get your own insurance. It's much less expensive. But if you don't, we have no choice but to force place insurance on it, and you'll be invoiced essentially for that. So it is something I think from an investor standpoint. Now, I say from the investor standpoint because look, everything ultimately falls upon you, the investor, but you should be working closely with your servicing company to try to get letters out or whatever you need to do, get that borrower on the phone, whatever it takes to, let them know they need to get their own insurance. It's obviously in every note and every mortgage that is written that they are required to have that. But, again, I think sometimes enlightening them as to what they have versus, paying a higher premium for forced places just makes sense. But
yeah, and then there's some people who can't get it,
Yeah.
So there's issues like that as well. So, and you guys in the note world probably experience any number of interesting situations. So, but yes, as long as if you're not on the deed, forced place is the appropriate insurance.
Okay, great. Now we have, before I get into land contracts and agreement for deeds, one of the popular models today is to buy real estate, maybe on individual property or in bulk, and then sell it as is with seller financing. Other models are buy a property individually or in bulk, renovate it, and then sell it with seller financing. And I would have to think that there's a complete separation in that as well. So let's talk about the one where if I'm an investor and I'm buying a property, real property, I'm going to have it renovated. It's in a different state where I am. I'm going to have it renovated and then I'm going to sell it. So I need a policy to cover me, for people getting hurt in the property, but also hazard, right? But because it's vacant, there's another type of policy. We used to call it builder's risk. Maybe it's something different today, but can you tell us a little bit about that type of policy?
Yes. So if you're doing major renovations or building from the ground up, you're going to need a builder's risk policy. And that, of course, covers a building while it's in construction or under construction. So then to layer onto that, there's another type of policy that is, it's very similar to the forced place policy. It's a master policy. And it is it has several different components to it. So in that type of policy, you can do light rehab. So for the fix and flippers, that's great because they are able to add properties when necessary, similar to the forced place policy, and then take them off when they sell them, when the rehab's done, but they're only paying for what they use because it's still, they're utilizing the online system. So they're only charged for the days they have that property on the policy, but it allows them to do light rehab. So, I'm talking anything that's above
Carpet paint,
8%.
drywall,
Yeah.
ceiling fans, stuff like, yeah.
Right. Yeah, exactly. The beautiful thing is it also covers the general liability. So you've got your property, your general liability, you can do light rehab, but you can also add loss of rent coverage. So this policy also works for the landlords, but it also is appropriate for the contract for deed folks. So it's sort of it's very similar to the forced place policy, but it is much more comprehensive and it adds the general liability. So it's sort of like the forced place on steroids, if you will.
Okay. So if this investor buys the property, they're getting it renovated, they get this builder's risk policy. Then when they change that transaction to go to either renting it or selling it to somebody else, in other words, there's going to be an occupant in there, they've got to update that insurance because the builder's risk won't cover at that point, right?
Correct.
Mm-hmm.
Yes.
So anytime investors listening, when you're changing your circumstances on that property, you've got to think in terms of you've taken on more risk. You now have a human being, that's going to be living in that property, that sort of thing. That's different than workers. And again, hopefully you all are, when you're getting work done, if you're hiring a GC, you're, making sure they are insured as well. Handymen typically aren't, keep that in mind, but that's what this type of policy would look into. But when your circumstances change and you go to renting, that whole different type of insurance that you need to switch over to. And if it is a master policy, like you were mentioning before, maybe it's a different because it was note side. If you have a master policy with your business like that, you can go online and make that switch yourself, or at least put the notification in there that it's changed.
So yes. So to back up. So we've got two different types of master policies. You have your forced place master policy.
Okay.
And then you have your real estate investor master policy.
Okay.
So your forced place master policy, that's appropriate for lenders, mortgage servicers who are dealing with, just servicing the mortgages, not contract for deeds. Your just any lender type, entity. Mm-hmm. And that will be, if your borrowers let their insurance lapse or if you are foreclosing. So that's your forced place. We're going to put that in that bucket over there. Then you've got your real estate investor policy, very similar. It's also a master policy, but it is for your contract for deeds people, your landlords, your fix and flippers doing light rehab, and then your contract for deed folks. Did I say that already? So you've got your fix and flippers, contract for deed, landlords. So that is the two buckets, and they're very, very similar. But the thing about the real estate investor policy is it adds the general liability in all cases. So it also has more broad coverage than your forced place policy. It's also less expensive, to be honest with you. Now, both are managed on an online system, and the online system is very similar with a few differences, tweaks, pertinent to that type of coverage. Now, builder's risk policies, that's when you're doing more extensive rehab or from the ground up. And that's going to cover you while you're in construction. So I know I've just thrown kind of a lot at you, but I'll use one of my clients out in Tennessee who does just a tremendous amount of everything, all things real estate investing. He's doing ground up builds, he's doing fix and flips, he's doing notes, and he's a landlord. So with his extensive rehabs and his ground up builds, he knows they have builder's risk. Then as soon as they hit that 80% and above, or they're ready to sell, kind of depends, he moves them over to the real estate investor policy. Then he's got a forced place policy for the notes and the things that he is not on the deed for. So sometimes they start out as notes.
Right.
They end up being on a builder's risk because they're going to be rehabbed extensively. And then he decides to keep them and rent them out and puts them on the real estate investor. Now, obviously, that's a complex situation. He has to have a lot of knowledge on, what type of property it is and where it's appropriate to put it. But we work together, and, he works with our office, and it goes very smoothly. So the main thing to know is, for your listeners, if you're on the deed, you need general liability. And if that is the case, the forced place policy is not the right policy for you. You need a real estate investor policy. That's
okay, and that's leading up to where I want to get into next, which is the bigger part of this topic, because for most of us in the industry, myself included, forced place insurance was kind of the key word of that's what we get on these type of policies. And the reality is that works fine when you have a note and a mortgage, as we were saying, or when you have a deed of trust and a note. That works because you're not on the deed. Now, I know, because I've looked at, I don't know how many different land contracts and contract for deeds, it says right in there, you can find the paragraph, I've seen it every single time, that the person, the occupant in that house under a contract for deed, and let me, just in case we have some new listeners, which we do all the time, a contract for deed is a different arrangement that you find in the creative financing world that's not in the bank world. Banks will not issue land contracts, or also known as contract for deeds, because they're not compliant to Fannie Mae guidelines. In the seller finance world, we don't have to worry about that compliancy because we're not selling our loans to Fannie Mae. So we can go into arrangement in a contract for deed, and I'm just going to use contract for deed now instead of land contract, everybody, but they're the same thing. In a contract for deed, I think it's more descriptive, because what you're doing is, if I own a home and let's say I bought it free and clear, I fix it up, and now I'm going to sell it to somebody with financing, I could choose to sell it as a note and a mortgage, or a contract for deed. If I go into a contract for deed relationship, that means the arrangement works like this. I'm going to stay as the owner of record on that property, and it'll be reflected in the county records that way as well, because I'm still on the deed. The borrower, who's going to be the occupant of the property, I've given certain rights that they have, the most important to them of which is the right of equity. So they have an equitable title to that property. However, they're not on the deed to the property until they pay me in full. Hence, they are under a contract for deed, a contract to get the deed. So that's the arrangement that we're going to focus on for the rest of this, because many of us have those notes, many of you create those notes, and you have to be aware of some things that you probably haven't seen in the industry. Because offline, Beth was telling me that she's been shouting this from the rooftops here, that, listen, everybody, you're not as covered as you think you are under the type of policies that you're getting, whether it's individually or even from a servicing company. So it's important to listen to what she's talking about on this. So we're specifically, again, talking about contract for deeds, whether you're creating them or whether you're buying the ones that are already created. In other words, assuming that loan in that position, you'll be on the deed. So you need to be aware of the different types of policies out there to make sure you're covered. Okay, so I just wanted to clarify that. Sorry, that's just to make sure everybody is hanging with us here. And again, I'm talking with Beth Boisseau-Coots. She's with JB Lloyd's, an associate and very high up in that company, and extremely knowledgeable. And again, thankful for having us on. So, okay, so let's take it from there. Contract for deed. Again, whether they're creating it or buying it, what are they typically getting right now that you've seen as an expert in the industry, and what should they be getting?
Okay, so typically they want forced place insurance. That's the term they know. That's what they think they need, and that's typically what they're asking for. And like we talked about earlier, that's only covering the unpaid balance or the loan balance, or the UPB or the loan balance. Hopefully I'm using your correct term.
The investment amount or the UPB.
Yeah. But it doesn't cover replacement cost, and it doesn't cover the general liability. So from an insurance perspective, despite the fact that, you guys might have this contract in place that says, the person, the borrower is in fact the homeowner and whatnot.
They have to have their insurance, and they're responsible for all the liabilities. They have to do everything. That's what the contracts essentially say.
That's what the contract
the reality
says.
is, you're telling us they can say that, but
from an insurance perspective, we don't care. We look at it, that is a landlord-tenant relationship, period. And and that's due to the exposure of having your name on that deed. So therefore, the appropriate insurance would be a real estate investor policy that includes general liability. So you'd want your property, your general liability, and in a perfect world, the borrower would also have their own renter's insurance policy that would cover their contents and $100,000 of general liability on their end. Because if they do damage to that property, again, in the insurance world, that's called tenant liability. That's what that is. So their policy would be triggered first. And then if the limits were used up, it would then go to the lender/contract for deed owner's policy. Now, I know that it's not a perfect world. And I know that many of the people that are listening probably have these with servicers who have them force placed. And therefore they have that exposure on the general liability side. And if that is the case, there is something they can do to protect themselves, and that is go get a general liability policy that covers all the contract for deed properties they have. So that way they have that general liability coverage should there be, some type of bodily injury or property damage claim that occurs with that property.
Okay. So if you have, what I heard was if you have forced place insurance, which most people I think listening don't have their individual policy, it's through a servicing company.
Right.
They want to cover the liability portion of that. So they get a general liability policy, and that would cover all of their contract for deed type of properties. And that would fill in that gap. And that way, if something does happen, and again, you're covered, already with the forced place insurance, again, if something happens to the property up to the limits that are set by that policy, either what you invested or the UPB, or if you're paying additional, as we said, possibly more, but in general terms, up to your UPB. But what happens if somebody gets injured on the property? You're liable, potentially liable for that. So you need that general liability policy, and that's huge. Where can they get those, and who can they contact to get those?
So really any agent, they can call us, we can do it, and we're familiar with this. So that's fine. And recently, in fact, it was with you, Kevin, that we were talking with another investor, and his State Farm agent was familiar with it, which I was so pleased to hear, because about half of my clients are actually other agents, because a lot of them don't have the knowledge of this particular space. So when I heard that, I just was so happy. So, they can go to their agent, and if their agent doesn't understand it, then they can have their agent call me, or they can call me. Okay. So, there's a lot of different ways. Just go out and explore it, and, see what, Yeah.
The general liability policy for contract for deeds, that is basically what we'd ask an agent and see if they give us the blank stare or if they go, yes, we're familiar.
Okay, basically think of it as rentals. I need general liability for rentals.
Gotcha. Gotcha.
And if they have rentals, they can include those too, quite frankly.
Right. Now, one of the servicing companies that you're working with personally, you're structuring them from the ground up, essentially saying if it's note and mortgage, forced place, if it's a contract for deed, you need to go with the real estate investor policy.
Yes, that is correct. We've started them out from the beginning with the two different policies, and we're still working through the kinks on it because there's been some turnover, but we're getting there, and so I'm pretty happy about that.
So your real estate investor policy then would include the general liability as well as the hazard type of insurance.
Yes.
And in a case like that, then just so I'm clear and the listeners are clear as well, if you have, let's say that's all somebody has. So they bought two contract for deeds and they got your policy for the real estate investor policy, as you call it. They don't need to now get a general liability policy. Well, they could, I suppose, but they don't need that because they're already covered with liability and hazard with that real estate investor policy.
Yes, that would be correct. So, but I will qualify that with the real estate investor master policy, they need to have at least 3 properties in order to, for us to have access to the carriers that do the master policies. That being said, we have carriers that will do one-offs, 1s and 2s, and we can still, it would still include that general liability, but the limits are not as high as they are on the master policy. The master policy limits are going to be 2 million per property per year aggregate, 1 million per occurrence. I mean, they're exceptionally high limits and they're very good. Typically the other ones are going to be 500,000 max. So.
Okay. Very good. Got that. Okay. And what about, on top of all of this, do you recommend general umbrella liability policies for some? Most of note investors form typically one LLC, and they own notes within that, where again they're not exposed to a lot, to general liability if it's note mortgages. But as you all are very clear of at this point in time, I would hope you are exposed if you have contract for deeds. And if somebody fixed this and said, okay, now I've got my real estate master policies, or I got my general liability policy in place, do you also recommend an umbrella liability policy for an LLC, or is that almost overkill? But I know they're so inexpensive, it almost seems like something people should do.
Oh, and that's such a good question. So I will answer it like this. It depends. And that's our favorite answer in insurance.
I love that answer. I can't tell you how many times I'm doing live presentations. Somebody asks me a question on notes. I'm like, I know you're not going to like the answer because it depends. I mean, it's just the best answer that you can get. Yeah.
And it totally does, because I have a number of clients in California that have really high net worth, and these folks do not think $2 million is enough per property per year aggregate with no policy limit. They think that is not enough. So I'm saying 9 out of 10 of my California clients are like, give me an umbrella policy over that bad boy. And it's always 5 million or more that we total it out at, so it seems like that 5 million is the sweet spot. So we put a 3 million umbrella over the master policy and we're good. But it depends. I mean, my family personally, we have rental properties up in the Dallas area, and we do not have an umbrella over it because we feel like 2 million's plenty per property. And knock on wood, that continues. So it kind of depends on your risk tolerance, how deep your pockets are, and what you might, might lose. I want to add to that though, too. You brought up another good point in the LLCs. With a master policy, I would say all of my clients have multiple LLCs, and they can all be added as additional named insureds to a master policy, just FYI.
Okay, great. So master policy. And then again, I always think of it as you got a master policy and then you can just add in each time you have a new LLC or something like that.
Yes.
You could just add it to that master policy. Great. What else might we be missing? Is there anything else you've seen in our industry that we're exposed to and we may not be aware of it?
Oh my goodness. Yes. One thing I will say is there's a couple things going on in
I
insurance
was
right
hoping
now.
you'd say no, by the way. No, that's it. That's all you're exposed to.
Well, it's a crazy world right now. We got some stuff. I mean, Hurricane Ian just really upset the apple cart in general,
Yeah.
and underwriting has gotten very, very tough just across the board with all types of commercial insurance, which this is all considered commercial insurance. So in the whole world of commercial insurance, whether it's a restaurant or a real estate investor or horse place, underwriting is a lot tougher than it was. Now it seems like it's calming down a little bit, at least in my world, but that is something, if you're out shopping insurance, give your agent or your carrier time. Give them some time, because that way they can work for you and get you the best. If it's an agent or a broker, they can get you the best coverage and premium that's available. If you're working directly with a carrier, that underwriter still is going to need, at least 2 weeks to process everything, and they're going to need information. It's sort of like buying a house in some cases. It is a process. So just keep that in mind. As far as other things, what else is going on in the world of real estate investors?
Flood insurance we kind of look at, for example, depending where the property is located, is there still a kind of a guideline there as to how far it is to a body of water that, you would look at if that's your collateral?
Well, yes. So Florida and the Gulf, anything on the tier 1 or tier 2 counties is going to be a lot more difficult to get, and it's going to be a lot more expensive. Some of my fix and flippers in Florida actually do it ex wind, because they know that they're not going to have the properties for very long, and then they time it out around hurricane season, and that does bring the premiums down, and that's helpful for them. I don't necessarily recommend that, just because wind claims in Florida, that is the largest premium, or the largest claim payments in the country every year is Florida, and it's all wind. So it's not something I necessarily recommend, but it works for some. If you are doing land, if you're a landlord, really, really try to get your tenants to have that HO4 renters insurance. It's so important. It can bring down your insurance costs, limit your exposure. So good. And another thing, I'm just going to throw this out here that I try to scream from the mountaintops as well, is the difference between replacement cost and market value. I hear a lot of people in the real estate investor world talk about, well, it's I want it insured for X amount because that's the market value. That's what it's worth. Right. Just a quick note here. Market value and replacement cost are not the same thing. Market value, obviously, it's going to be based on what the comps are in that area for similar home. Replacement cost is what the cost is to rebuild a property, labor and materials, 2 different things. So when your agent or, when they give you okay, this is the replacement cost, don't freak out if it's way above or way below what your market cost, what you think it should be valued at. It's a completely different thing.
Yeah, I remember from my old appraisal days, on commercial property, you looked at it from 3 different approaches, and you'd say one would be comparable sales, and then another one would be income. What does it produce? But you're right, cost approach. Well, what would it cost for us to rebuild it? You certainly have to look at that. So value, especially value, is always different for taxes and for IRS valuations or wherever you're looking at. Insurance is going to be different. And so, yeah, it's important to have a distinction on that. So no, I appreciate that. Yeah.
And it's gone up. It's the average in the United States now is 140 per square foot, whereas 2020, it was $100 per square foot. So it's definitely inflation has caught up with the replacement costs.
Gosh, I'll be dating myself, but it used to be Marshall and Swift used to be the company that did all of that guidelines. That's what things cost, and I think they got absorbed by CoreLogic or somebody. I'm sure.
No, I'm dating myself too, because that I still want to say, oh, they're the valuation tool. It's Marshall Swift. But then I have to remember. Wait a minute.
Used to get the book every year, get the new updated book. Yeah. There's somebody bought them years ago. I can't remember who that was, but yeah, they track all that, which makes sense, a replacement cost and the other, and that's good, because most of the time as note investors, we're way below what any replacement cost I think would be for that. But one other question I've got, because I have some people that buy notes on vacant land, and I bet they're wondering, well, what about vacant land? Are we liable for anything, or what kind of coverage might they need?
Just general liability.
Just general liability.
Yes.
Because there's no structure, obviously. I mean, the land's going to be there, so you want, even if it's land like out in the middle of nowhere, and it's just, you don't own the land, you're not on the deed, you just have a note on it. Still good idea to get general liability.
Well, yes, as an insurance person, I'm not very risk tolerant, so I say yes, get it. But if you're not on the deed, I would say for sure, if you foreclose on it, then you want to have that general liability in place. If it's just a forced place thing where the borrower is not keeping the general liability on there or whatever, you're probably okay. You probably don't have much to worry about there.
So again, it depends.
It depends.
Yeah. So, hopefully what everybody's learned from this is, insurance is a big part of this. It covers the unknown stuff in life. And it's very important that we have good relationships with them, and we just can't assume that the servicing company, look, servicing companies aren't insurance companies. They're not specialists. It's a service that they provide, but ultimately we need a good relationship with insurance parties that can tell us, are we covered on this, or what's the best for us to have. So do we have an email or a website that I can send people for your company and such there?
Yes. My email, it might be easier. I'm going to spell it for you because it's just a nightmare. It's
okay. I didn't know if you wanted your email or someone else's or the company website. That's up to you.
Oh, yes. So you can give them mine. If you've already got it, if you want to just add it at the end, that works for me, or I can give it to you now.
Okay, go ahead and give it to us now, and I'll add it on the description as well.
Okay, so it's E Boisseau, and that's E for Elizabeth, B as in boy, O for Oscar, I like ice cream, S like Sam, S like Sam, E like egg, A like apple, U like umbrella, at Lloyd, that's LLOYD -INS.com. So eBoisseau at Lloyd-INS.com.
Awesome. Thank you so much for that. I really appreciate this. It's a under talked about topic, and one that's very important. And thanks for really clarifying the whole thing with land contracts. I mean, I would bet, safe to say that the vast majority of investors in those instruments really just assume the coverage is there, and it may not be everybody. So let's make sure, go back, check your policies, contact your agent or contact Beth, and make sure that you're covered on these things, and you'll be able to sleep better at night.
Yes, and hopefully we didn't put people to sleep with this insurance conversation.
I don't think so at all. I find it fascinating here. It is important, and so I like it. It's something. Again, I had some misconceptions of part of that. I have to confess myself, and if I did, I know that means that many others did as well.
You are in good company. It's very common. But no, if anybody has any questions about this after they listen to all of this, they are welcome to call me or email me. I'm always happy to walk people through it and try to make it clear.
Great. Fantastic. So thank you once again, Beth. I really appreciate you coming on the podcast here with me.
Well, thanks, Kevin. It's been nice.
Okay, everybody, there's another episode wrapped up for you. Look forward to putting together another one for you very soon as well. And keep an eye out. I'm probably going to do a virtual 3-day coming up here, and I'll let you know that through my website. So again, you can go to realestatewithoutrenters.com, or you can email me at Kevin Shortell. That's Shortle, right? Kevin at kevinshortell.com. And hey, if you're brand new to this and you want to talk with 30 minutes, I'll even send you a scheduler. We can talk about what you're doing in the business and how it might be able to help you with that. So thanks again, everybody. Do appreciate it and look forward to talking to you again real soon.